If you open up your brokerage app right now, you are staring at a menu with over 8,000 different options. You have individual stocks, you have mutual funds, you have options, you have futures, and you have crypto coins named after dogs. It is the financial equivalent of the Cheesecake Factory menu. It is overwhelming, it is confusing, and it is designed to give you decision fatigue. The financial industry wants you to believe that to be a successful investor, you need to be a gourmet chef. They want you to believe you need to pick the perfect ingredients, mix them in the exact right ratios, and watch the oven constantly so nothing burns. They want you to believe this so you will hire them to do the cooking for you. But the truth is, you don't need to be a chef. You just need nutrition. I used to be the guy trying to cook up a 5-star portfolio. I had 30 different stocks. I had sector ETFs for green energy and 3D printing. I was checking my phone under the dinner table to see if the Asian markets had opened yet. I was stressed, I was paying a fortune in trading fees, and my returns were actually lower than the average. I was doing too much. Today, my portfolio is worth significantly more than it was back then, but it is incredibly boring. I don't own 30 stocks. I don't trade options. I own exactly 3 exchange-traded funds, or ETFs. That's it, 3 tickers. This is known as the 3-fund portfolio. It is the simplest, laziest, and mathematically most powerful way to build wealth over a lifetime. And in 2026, where the market moves faster than ever, this simplicity is your only safety net. Let me explain exactly what these 3 funds are, why I chose them, and why this boring strategy will likely outperform your smartest friend who trades on margin. The philosophy here is simple. Stop looking for the needle in the haystack. Just buy the haystack. When you try to pick individual stocks, like trying to guess if Nvidia is going to go up or down next week, you are gambling. You are betting that you know something the market doesn't. But when you buy the whole market, you aren't gambling on a company, you are betting on capitalism itself. So let's break down the 3 ingredients of this wealth recipe. Fund number 1, the total U.S. stock market. This is the engine. This is the main course. This ETF buys a tiny slice of almost every single publicly traded company in the United States. We're talking about thousands of companies. You get Apple, Microsoft, and Amazon, but you also get the medium-sized companies making the parts for the cars and the small companies you've never heard of that might be the next Google. Why do I put the majority of my money here? Because never bet against the American economy. Despite the inflation, despite the politics, despite the doom and gloom on the news, the U.S. stock market has been the greatest wealth-generating machine in human history. It is resilient. It adapts. Now, a lot of people say, Warren, why not just buy the S&P 500? Why the total market? The S&P 500 is just the 500 biggest companies. And sure, they are great, but by buying the total market, I catch the little guys too. Small cap stocks, the smaller companies, historically have periods where they explode in value. If you only own the big giants, you miss that growth. I want to own the next giant before it becomes a giant. Therefore, I own it all. If a company goes bust, it's a tiny speck in my portfolio. I don't even feel it. But if a company takes off, I participate in the upside. But investing only in the U.S. is dangerous. This brings us to the second ingredient. Fund number 2, the total international stock market. This is where I lose a lot of people. They say, Warren, the U.S. has crushed international markets for the last 15 years. Why would I put money overseas? That is called recency bias. You are driving while looking in the rearview mirror. Yes, the U.S. has been on a tear, but markets move in cycles. In the 1980s, the Japanese stock market was the king of the world. In the 2000s, emerging markets crushed the U.S. Winners rotate. If you put 100% of your money in the US, you are betting that America will be the sole winner forever. That is a risky bet. I view my international ETF as regret insurance. If the US market goes sideways for 10 years, which has happened before, and the European or Asian markets take off, I want a piece of that action. I don't want to be sitting there watching the rest of the world get rich while my portfolio stagnates. By owning a total international ETF, I own companies like Samsung, Toyota, Nestle, and TSMC. These are massive global powerhouses that happen to be headquartered outside of New York. When you combine Fund 1 and Fund 2, you literally own the entire world. You own the global economy. As long as humans are waking up, going to work, buying toothpaste, and innovating, you are making money. But stocks are volatile. The global economy is a roller coaster. This leads us to the most controversial ingredient in 2026. Fund number 3, the total bond market. I can hear you groaning. Bonds? Warren, bonds are for old people. Bonds are dead money. I get it. Bonds are not sexy. Bonds are not going to make you rich overnight. But you don't buy bonds to get rich. You buy bonds to keep you from getting poor. Think of your portfolio like a race car. The stocks, US and international, are the engine. They provide the speed. They provide the growth. The bonds are the suspension and the airbags. When the stock market crashes, and it will crash, it can drop 30%, 40%, or 50%. We saw it in 2008. We saw it in 2020. If you are 100% in stocks, your net worth gets cut in half. Now, mathematically, if you just hold on, it will come back. But psychologically, that is a different story. When you see your life savings drop by 50%, you panic, you freak out, you sell at the bottom because you just want the pain to stop. That is how you destroy wealth. Bonds are there to soften the blow. When stocks crash, bonds usually hold their value or even go up. They act as a counterweight. So instead of dropping 50%, maybe you only drop 30%. That sounds bad, but it might be the difference between panic selling and staying the course. The bond ETF pays you regular interest, monthly dividends, just for holding it. It's boring, steady income that stabilizes the ship while the storm rages outside. So how do you put this together? It comes down to your asset allocation. That's just a fancy word for the recipe. If you are young, say in your 20s or 30s, you have a lot of time. You can handle the volatility. Therefore, you might have a recipe that looks like this: 60% total US market, 30% total international market, 10% total bond market. You are heavy on the engine, light on the airbags. If you are older, say in your 50s like me, you don't have as much time to recover from a crash. Therefore, you need more safety. 50% total US market, 20% total international market, 30% total bond market. You increase the bonds to protect what you have built. Now, here's the secret sauce of the 3-fund portfolio. It's not just about buying them, it's about managing them. And the management takes about 15 minutes a year. It's called rebalancing. Let's say you start with a 50-50 split between stocks and bonds. One year, the stock market goes crazy. It goes up 20%. Your stocks are huge. Your bonds stayed flat. Now your portfolio is 60% stocks and 40% bonds. You are now taking more risk than you planned. So once a year, you log in, you sell some of the winners, and you buy more bonds, the losers, to get back to 50-50. Think about what you just did. You sold high and bought low. You didn't predict the market. You didn't watch the news. You just followed the math. By mechanically rebalancing, you force yourself to take profits from the winners and invest in the undervalued assets. It removes the emotion. It removes the "should I sell now" anxiety. The spreadsheet tells you what to do. The fake rich trap versus the three-fund portfolio. The fake rich guy is constantly tinkering. He's buying options on earnings reports. He's paying 1% or 2% fees to a financial advisor who is just guessing. He's stressed out of his mind. The three-fund investor is free. I don't care what the Federal Reserve does next week. I don't care who wins the election. I don't care if tech stocks crash or oil prices spike. If tech crashes, my US fund might dip, but maybe my international fund goes up. If everything crashes, my bonds hold the line, and I use that opportunity to rebalance and buy more stocks while they are on sale. I have built a system that benefits no matter what happens. And the best part? The cost. The ETFs I buy, and I'm not sponsored, but think VTI, VXUS, BND, or the Fidelity or Schwab equivalents, have expense ratios of like 0.03%. That means for every $10,000 I invest, I pay the fund manager $3 a year. $3. Compare that to a mutual fund that charges 1%. That costs you $100 a year. Over 30 years, that 1% fee can eat up to 1/3 of your entire retirement. By keeping costs low, you keep more of your own money compounding for you. Why is this so hard to do? If this is so easy, why doesn't everyone do it? Because it's boring. We are addicted to excitement. We want the story. We want to tell our buddies at the bar that we bought this tiny biotech company that's going to cure baldness and make us millions. Telling your buddies, "I bought a total market index fund," is a conversation killer. It's dull. But do you want to be entertained, or do you want to be wealthy? The stock market is not an entertainment product. It is a wealth-building tool. If you want entertainment, go to the movies. Go to a casino, take $500 and bet it on black. That's fun. But with your life savings, with your freedom fund, you want to be as boring as humanly possible. I have seen so many people blow up their accounts chasing the next big thing. They put 50% of their net worth into a single stock. The stock drops 80%. They panic sell. They lose a decade of hard work in a month. The three-fund portfolio protects you from yourself. It prevents you from making the fatal mistake, the set-it-and-forget-it reality. When you adopt this strategy, your relationship with money changes. You stop checking the app every day. In fact, you shouldn't check it more than once a month. You focus on what actually matters, your income and your savings rate. Since you know the investing part is handled, you can pour your energy into your career. You can work on getting that promotion. You can start that side hustle. You can focus on increasing the amount of money you shovel into the machine, knowing the machine will handle the rest perfectly. It gives you your brain back. How to actually start. You don't need a fancy financial advisor to do this. You can open a brokerage account at any of the big firms. You transfer your money, you look up the 3 ticker symbols that correspond to the strategy: total US market, total international market, total bond market. You click Buy. That's it. You are now a global investor. You are now the owner of the world's greatest companies. And here is the kicker. By doing this, you will statistically outperform 90% of the professional hedge fund managers over a 15-year period. Those guys in the $5,000 suits, the ones with the algorithms and the insider info, they can't beat the market because their fees are too high and they trade too much. By being lazy, by being cheap, and by being simple, you win. Now, I know this sounds great in theory, but the hardest part is actually pressing the button the first time. It feels scary to put your hard-earned cash into the market. Let's get to work.